Okay, good day, everybody. Welcome to my Stock Investing 360 YouTube channel. I decided to post another monthly stock pick because I found this stock a couple of days ago. Basically, again, for those who are not familiar with Stock Investing 360, you can go have a look on our website, stockinvesting360.com. And my investing criteria, so basically I've built a portfolio that is based on companies that are profitable, that have a strong balance sheet, and that are valued according to market, or according to growth as well. I look at the current value, but also the growth potential of the company I'm investing in, and I also take a look at what analysts have to say about the companies I'm investing on, or the companies I'm considering investing on. Today I'm going to talk to you about stock pick, or I would probably call it the stock review of the Sherwin-Williams company, trading under the ticker SHW. Before we get any further, I just wanted to say that I do not own any share of this company as of today. Uh, this tutorial is not meant as a recommendation to buy or sell shares of this company. So if you want to invest, or if you want to have a look, you should conduct your own analysis and decide if this is an investment that is good for you, and if that investment meets your criteria of investing. So let's now have a look at this company, Sherwood-Williams Company. First of all, it's a fairly large company. It has a market cap of $37.8 billion. So we're not talking about here a small company that has a lot of room to grow, even though when we'll look at the numbers, the financials, and the growth, there's still some room to grow for this company. The Sherwin-Williams company is headquartered in Ohio, and it's trading on the New York Stock Exchange. So basically, in a nutshell, the company is developing, manufacturing, distributing, and selling paints and coating products in the industrial, also residential sectors. This is basically what it does. Obviously, we should expect that during a strong economy, and when the economy is doing well, this company should be able to do well. If there's a downturn to the economy, a slowdown, we should expect sales to be reduced, because it's basically selling industrial products, and if industrial projects are slowing down, it could have an impact on the net profits or expected growth of this company. So right now, what we'll do is we'll look at what the company has done in the last 5-10 years, to see how it increased its profit, its revenues, and what we could expect in the future. So before we go any further, if we look at the profitability of this company for the last well 9-10 years, so starting in 2007 to 2016, so the company had about $8 billion worth of revenue in 2007, and in 2016, when it published its annual report in December, it had produced $11.8 billion of revenues. So that's roughly between 2007 and 2016. It's about a 4% per year growth. It's not huge, but for a company this size and operating in an industrial sector, it's not too bad. And we see that have been a couple of rougher years here. That's basically when we had the the slowdown, the economic slowdown in 2008, 2009. So basically, the company will be affected by any economic slowdown, but it picked up the pace again, and it's doing pretty well. And those are potential estimates for 2017 to date. So that's okay. We can see definitely a trend here. The company is producing more revenue year after year. If we look at the 5 years of, well, it's 4 years, 2012 to 2016 is about 4 years. Revenues growth, so the company grew its revenue by 5.6% per year. So that's okay. Now, if we look at the profit between 2007 and 2016, the company grew its profit by 6.9% average per year. That's interesting. But what I like is between 2012 and 2016, the company grew its profits by 15.7%. So that's good for investors looking for a stock that has a good vibe, and also that has the win in its sales. So obviously, last 5 years in terms of profitability, Sherwin-Williams have done pretty good. Now, we don't want to invest in a company that is in financial trouble or in debt, that it can't pay its liabilities, and so we have to look at the balance sheet. So this is a screenshot of the past 5 years worth of in the annual reports of the balance sheet. So let's look at the last year, because this is the most recent information we have. So basically, I like to look at the current ratio. So how much current asset the company has, and how much debt it needs to pay back in the next year. So basically, if you have more current asset than current debt, you are able to sustain the pace. So the company has a ratio of 1.28, so it has 1.28 times more current asset than current debt. So that's fine. We always look at something. We want to be over one for companies that in which we want to invest long term. I like to see it a bit more at 1.5, but 1.28 is not too much of an issue right now. Another number I like to look at is how much the company has grew the shareholders' equity, so the book value of the company. In this case, when we look at the company between 2012 and 2016, stockholders' equity went from 1.7 billion to 1.8. So that's about the 1.2% average per year of growth. Not too much, it's not a lot actually, but we need to look at the treasury stocks here. So basically, the company is purchasing its own share and it's keeping it within the company. So that is subtracted, but it's there. So that's interesting. The company basically have used some of the cash that was available to it to purchase some of its own stock. So that's interesting here. So it kind of, in that case, maybe looking at shareholders' equity growth doesn't make that much sense. I still like to calculate it, and then I like to analyze if it makes sense, or if in that case it's relevant or not. I would probably stick to the current ratio, which is above 1.1. I like to be at 1.5, 1.28 is not too bad. So the company was well financed to sustain its operations for a while. Now, valuation and growth, it's not a cheap company. It's currently selling at one share is worth $404.80. But obviously, that that means that you have to pay that much money to own a share. But you want to know how much of the net profit is associated with the share. In that case, we have a price to earnings ratio of 35.61. That's above what we like to see. Value investors might find this to be too expensive. They will try to see if they can find stocks that are trading at PE of maybe 20, maybe 19. It depends on the industry. It depends on the stock. In that case, for an industrial stock, 35.61 is on the expensive side. However, we can see that associated with that PE, there's a growth, an average growth. That's given by the analyst. So we'll come down to this number on the next slide. The analysts are predicting. Obviously, it's a forecast, so it can be right, it can be wrong, but I still like to use that number of an average growth of 17.19%. So that's in the upper teens, so that's good. So if we decide to calculate the price earnings to growth ratio, so you divide 35.61 by 17.19, you obtain 2.07. So I like to try to find companies that are trading with a peg of less than 2. Ideally, the lower the better, but 2.07, it's close to the threshold that I find interesting, and that company is worth having a look at. So when we look at growth estimates by the forecast by the analyst tracking the stock, we can see that the growth expected for this year and for the next 5 years and for the past 5 years too, everything is around 20. So the company has done very well lately, and that's why the stock went up quite nicely in the past couple of quarters. But there's still some room to grow, and for growth investors, paying $35 for each dollars of earning, but getting potentially 17, maybe 18 if the company can do better than expected, that can be an interesting investment for the next 4 or 5 years. Now, I also like to look at analyst opinion because they do have an impact on how the stock is perceived. If the stock has a positive vibe, it should do better than stocks that have negative vibes. So the analyst will have an impact on that. So, like I said, well, first of all, recommendations. So there's 23 analysts tracking the stock. 8 of them, as of December 2017, have a strong buy recommendation. 8 of them have a buy recommendation, and 7 of them have a hold recommendation. And we can see here that from September to December, there was one analyst recommending underperforming on that stock, and this guy probably moved to the hold recommendation, and one guy that had a hold recommendation went to recommend the purchase of the stock. So it's, I mean, you can do whatever you want with this. Normally, I like to look at the average recommendation, buy or better, ideally. Sometimes I can live with something between 2 and 3. In that case, we can also see that there seemed to be a shift of opinion that is positive towards the company, which is, I think, a good thing. Growth potential next 5 years, as I said, 17.19%. That's the average expectations and forecast from the 23 analysts. So that's interesting. Price target next year, 36. Sorry about that. Yeah, that's a typo here. It's the average price target is $418.20, and basically the stock is currently at 404. So there's about a 3.2, 3.3% upside. That's not a lot, but again, if the company keeps meeting the expectation, the price targets should be moved up as we move forward in the next year, and obviously the upside will grow as hopefully the value of the stock, the price of the stock. Another thing that I like is the revenue estimates, again from the analyst opinions, that those are forecast. So we can see that current quarter, December 2017, the estimate growth year to year is 41.8%. That's very good. Next quarter, for March 2018, they expect to have a growth increase in the sales of 43.30, and then this year to next year, a 25 and 18% growth in the revenues. So that will translate in more profits. That should help the stock move forward. And again, if I like to invest long term on a stock, so I don't want to invest only for 1 or 2 good years. I like the fact that this is expected to be sustainable for the next 5 years. So I'm not an owner of this company yet. I don't own shares, but I must admit that I have put this stock on my watch list, and I think I will wait for the next financial report of that company make sure that it matches the forecast, and then I will definitely consider potentially investing some of my money on it. So, as I said, I'm not an owner of this company. I don't say that you should or not purchase or sell this company. You should do your own analysis to see if it matches your investment criteria. So I hope this is useful for you, and I should post other analysis and stock picks and reviews like this one in the next weeks. So I hope that this will be useful for your investing performance. And see you soon. If you want, you can also visit my website, www.stockinvesting360.com. I provide some information on how to invest on stock markets for the beginners and intermediate investors. And members can also have access to a model portfolio that I've put together. And the goal is to beat the indexes. So far we've done well. I hope that this will continue in the following years. So, bye.